The company sitting at the center of the AI boom is no longer content to just sell the hardware. It is now bankrolling the very ecosystem that buys, deploys, and depends on that hardware. That is a fundamentally different kind of market power, and it changes everything about how we should think about the AI economy. By the end of this video, you will understand exactly how Nvidia has built a financial flywheel that turns its chips, its capital, and its strategic partnerships into a self-reinforcing cycle, and why that cycle could either make Nvidia untouchable or create a massive point of systemic risk, depending on how the next 18 months play out. Here is what we know. Nvidia has reportedly already committed more than $40 billion to equity investments in AI companies during the early months of 2026 alone. That is not lifetime deal-making. That is just the first few months of this year. A huge chunk of that comes from a $30 billion investment tied to OpenAI, but the rest is just as significant. Nvidia has made multi-billion-dollar moves involving companies like Corning and IREN. The company announced a separate $2.3 billion investment in optical technologies designed to enhance AI chip performance through next-generation silicon photonics. Jensen Huang himself said at the 2026 AI Summit that optical interconnects will be the next frontier in AI computing, and that AI is the new electricity, and we are at the beginning of a loop that will redefine financial systems. Nvidia also launched what it calls the AI Money Loop Initiative, committing an additional $1,200 million in venture capital for AI-driven fintech startups. On the software side, Nvidia released CUDA Finance 2.0, a platform that enables real-time blockchain transaction analysis for banks, and simultaneously partnered with Mastercard to integrate AI-powered fraud detection across more than 150 countries by the fourth quarter of this year. Cloud infrastructure spending jumped 45% in the first quarter of 2026, compared to the fourth quarter of 2025. Nvidia's own AI chip sales showed a matching 45% surge over the same period, bringing the company's total AI chip revenue to $12.7 billion for the fiscal year. 78% of AI startups still run their training workloads on Nvidia GPUs. The market is forecasting 300% growth in AI chip demand by 2027. That is not a slow transition. That is a tidal wave, and Nvidia is making sure it sits in the middle of it. Now let's talk about why you should care right now. This is not just a story about a profitable chip company. This is about whether the entire AI infrastructure build-out is becoming financially self-reinforcing in a way that obscures real underlying demand. When the primary seller of hardware also becomes the primary investor in the buyers of that hardware, you create a system where growth signals can get amplified. Revenue numbers look stronger, deal pipelines look deeper, stock prices go higher, and then that stock value gets recycled back into more investments. From the outside, it looks like a booming market, but you have to ask whether all of that demand would exist without Nvidia's own capital keeping the wheels turning. To understand how we got here, you have to look at how Nvidia's strategy has evolved over the past several years. At the beginning of the generative AI wave, Nvidia's position was straightforward. The company made GPUs that were vastly superior for parallel computation. CUDA, Nvidia's software platform, locked developers into its ecosystem. Training a model on Nvidia hardware was easier, faster, and often the only practical option. That created enormous revenue. But even then, Jensen Huang started looking beyond the chip. He recognized that compute alone does not scale. The bottleneck would become networking, power, cooling, data center construction, and the physical supply chain. That recognition led to a series of strategic acquisitions and partnerships. Nvidia's acquisition of Mellanox Technologies for $1,200 million gave the company deep control over high-performance networking hardware. Mellanox makes InfiniBand and Ethernet adapters that connect GPUs inside data centers. Without fast interconnects, clusters of GPUs cannot function as a single computational unit. Nvidia knew that owning the networking layer was just as important as owning the accelerator. But the real shift happened this year. Nvidia moved from selling and acquiring to actively investing. The Corning deal is the clearest example. Corning manufactures specialty glass and fiber optic components that are essential for connecting processors inside massive AI data centers. Nvidia and Corning announced a partnership to expand United States production of optical connectivity products for AI data centers. Corning said it would increase its US-based optical connectivity manufacturing capacity tenfold and expand domestic fiber production by more than 50%. 3 new advanced manufacturing facilities are going up in North Carolina and Texas, creating more than 3,000 jobs. And here is the critical detail. Nvidia made a multi-billion-dollar prepayment to help fund those factories, entirely separate from a previously disclosed equity investment of up to $3.2 billion. Nvidia is not waiting for the supply chain to scale. It is pushing capital into the supply chain directly. Then there is IREN, a company that originally came from the Bitcoin mining space and has pivoted toward AI infrastructure. Nvidia secured the right to buy up to 30 million IREN shares, while IREN entered a multi-billion-dollar cloud services agreement with Nvidia. That deal blurs every boundary. Nvidia is simultaneously the hardware supplier, a cloud services provider, an investor, and a strategic partner. You cannot neatly categorize what Nvidia is doing anymore. Now let's get into the numbers and the timeline, because the scale of these moves matters. In the first quarter of 2026 alone, R&D spending across the AI sector increased 40% compared to the previous quarter. Nvidia allocated $750 million for quantum computing research in its current fiscal year. The company established 12 new AI research labs across 6 countries this year. Nvidia is projecting 200,000 new AI engineering positions will be created by 2028, and the company set aside $500 million specifically for AI ethics and safety initiatives. OpenAI's Stargate project, which requires deploying a global network of high-performance computing clusters, represents one of the largest single consumers of that infrastructure. Sam Altman told investors that OpenAI is prioritizing seed-round partnerships over public funding. That means private capital, a lot of it coming from companies like Nvidia, is what is driving deployment. This is where the phrase circular deals comes up, and it deserves a careful explanation. A circular deal occurs when one company invests in another company that then purchases, supports, or depends on the first company's products and services. Bloomberg published an explainer on circular AI deals earlier this year, noting that the structure is not automatically illegal or deceptive. In a rapidly growing market, it can be a legitimate mechanism to accelerate infrastructure deployment. Company A provides capital to Company B. Company B expands operations. Company B purchases more of Company A's products. If real underlying demand keeps growing, everyone benefits. But the risk is structural, and it is real. If actual demand for AI services does not grow as fast as the infrastructure being built, the loop becomes fragile. The hardware seller may depend on customers who are partially financed by the seller's own capital. Those customers depend on continued investor confidence and revenue growth. The investor depends on rising valuations. As long as the market expands, the flywheel spins. If growth slows, the same mechanism that accelerated expansion can amplify contraction. That is the core tension. From Nvidia's own perspective, none of this is reckless. It is strategic moat building. The company understands that competing on silicon alone is not enough when AMD and others are closing the performance gap on individual chips. The real advantage comes from controlling the entire stack: the hardware, the software platform, the developer ecosystem, the networking layer, the supply chain relationships, the cloud partnerships, and now the capital that funds deployment. That is how you make yourself indispensable. You do not just sell the best chip, you help define and finance the entire market around the chip. The Corning deal illustrates this perfectly. Nvidia does not need to become a glass manufacturing company. It just needs the glass manufacturing company to grow fast enough to support the AI build-out. When Corning scales production, data centers scale faster. When data centers scale faster, more GPUs get installed. When more GPUs get installed, Nvidia's revenue grows. It is vertical influence without full vertical ownership. That is a smarter play than trying to own every layer yourself, because it keeps capital efficiency high while still directing the entire ecosystem. But here is the uncomfortable question that regulators, investors, and competitors are starting to ask. How much of the 45% growth in cloud infrastructure spending this quarter is organic demand, and how much is being pulled forward by Nvidia's own financial commitments? There is no clean answer yet, but the concentration of financial and operational power in a single company is unprecedented in the semiconductor industry. This concentration creates a much steeper competitive challenge for anyone else in the space. For AMD and Intel, the problem is not just building a competitive chip, it is competing against an entire system. Nvidia has the superior hardware, the CUDA software ecosystem, the developer lock-in, the deep relationships with cloud providers, the enormous cash position, the stock valuation that funds more investments, and now increasingly the infrastructure deal-making power. When one company becomes the supplier, investor, strategic partner, and ecosystem kingmaker simultaneously, the playing field changes. Competitors face a system, not just a product. The AI boom is also spreading far beyond software and chatbots. This is now a physical economy story. Factories in North Carolina and Texas are being built to produce fiber optic glass. Data center construction is reshaping local power grids. Cloud providers are competing for GPU capacity. Supply chain bottlenecks in semiconductors, networking equipment, and cooling systems are creating new bottlenecks. AI is becoming industrial infrastructure, and Nvidia is systematically ensuring it sits at the center of every layer. So is Nvidia buying its own demand? The most honest answer is that it is doing something more sophisticated than that. Nvidia is not handing out capital randomly. Every investment is a targeted bet on a company or supplier that expands the total addressable market for AI compute. The Corning investment strengthens optical connectivity. The IREN deal builds cloud compute capacity. The fintech venture fund creates new AI applications that require Nvidia hardware. The CUDA finance platform locks financial institutions into Nvidia's software stack. Each move expands the pie while simultaneously securing Nvidia's slice. If those bets succeed, Nvidia strengthens the entire ecosystem and locks in its central role. But the harder truth is that the stronger this loop becomes, the more important it is to monitor what happens if the underlying economics break. What happens if AI revenue does not keep pace with AI infrastructure spending? What happens if companies cannot monetize the compute capacity they are building? What happens if investor sentiment shifts and capital dries up? In that scenario, the same flywheel that drove growth could also accelerate a downturn. Companies that were built with Nvidia's capital could face cash crunches. Nvidia's own revenue could drop. The valuation that enabled these investments could contract. A loop that works in one direction can work against you in the other. There are also regulatory and antitrust considerations that could surface. While no enforcement action has been announced, the pattern of a dominant supplier simultaneously investing in its customers and suppliers creates exactly the kind of ecosystem control that antitrust authorities monitor. If Nvidia's market position strengthens further through deal-making rather than pure product competition, expect legal scrutiny to increase. The timeline for that is uncertain, but the precedent exists in other technology sectors where dominant platforms face challenges for anti-competitive ecosystem behavior. What should you watch over the coming months? First, keep an eye on OpenAI's Stargate deployment timeline. The success of that global high-performance computing network depends on hardware availability, data center construction, and power infrastructure. If Stargate hits delays or faces cost overruns, it would ripple through Nvidia's investment thesis. Second, watch the fourth quarter of 2026 for the Mastercard partnership launch. AI-powered fraud detection across 150 countries represents a massive deployment of Nvidia's fintech stack, and early adoption metrics will tell you whether enterprise AI demand is as strong as the infrastructure spending suggests. Third, monitor Corning's manufacturing ramp. If the new facilities in North Carolina and Texas come online on schedule, it validates the supply chain thesis. If they face delays, it signals broader infrastructure bottlenecks. Fourth, track AMD and Intel's next-generation chip announcements, because any genuine competitive threat could reduce the concentration risk that Nvidia is counting on. Finally, watch Nvidia's own quarterly earnings and guidance closely. The revenue numbers will look strong, but the quality of that revenue, how much comes from organic customers versus companies Nvidia has invested in, will be the key metric for anyone trying to assess whether this loop is durable or fragile. The AI race was always going to be about more than just chips. It was going to be about capital, infrastructure, supply chains, and control. Nvidia understood that before most companies did, and it has moved faster and deeper than anyone else to secure its position at the center. That makes Nvidia one of the most important forces shaping the next phase of technology. But it also means the entire AI ecosystem is now more connected to a single company than it has ever been connected to any single company before. That is power. And power always creates new risks. Stay sharp. Jane Sterling, Sterling Intelligence.